So, traders, what exactly is a breaker block? A breaker block is a trading concept built around a simple idea. It's a previously failed order block that transforms into a key supply or demand zone on the price chart. This happens when an order block is broken in the opposite direction, shifting its role from supply to demand or from demand to supply. In practice, a breaker block represents a structural role flip, where a former reaction zone becomes an area that price is likely to revisit, often serving as a mitigation point and a location where traders add to their positions. There is also an important principle to keep in mind. Whenever price breaks through a key demand or supply zone without showing respect, that zone automatically shifts its characteristic. A supply zone becomes demand, and a demand zone becomes supply. The same principle applies to order blocks. The market may ignore the supply or demand of an order block for several reasons, such as shifts in market structure, overvalued or oversold conditions, interaction with higher time frame key areas, major economic news releases, or other fundamental drivers. When a valid demand order block fails to reject the price and the market breaks through it to the downside, it turns into a supply level known as a breaker block. In this situation, we expect the price to reject that zone and continue pushing lower. Now, let us look at the psychology behind the breaker block and understand how it works. Imagine a bullish break of structure forming above the last high with inefficiency. This movement creates a valid order block tied to that break of structure, giving traders a reason to look for long entries. However, if the price later shifts market structure by pushing and closing below the most recent low, the directional bias flips to bearish. When this happens, the original demand level loses its strength and turns into a supply level as the price breaks through the order block to the downside. The psychology behind the breaker block is straightforward. Traders who went long from the original order block now find themselves trapped. They wait for price to return to break even so they can exit without taking a loss. When many long positions close in the same zone, a surge of sell orders enters the market, creating strong downward momentum. At the same time, retail traders often see the previous structure shift as a trend line breakout. They expect the price to pull back for confirmation, which leads them to look for short setups at the retest area, also known as the breaker block. Many traders will short this zone because they view it as a key supply area. Combined, these actions turn the breaker block into a clearly defined supply zone with a high probability of generating short opportunities and driving price reversals. One more point to note is that breaker blocks tend to be most effective when the market is trending strongly in either direction with shallow pullbacks, and when price is not respecting premium or discount supply and demand levels along the way. Now let us move to the next topic and look at how breaker blocks are identified from a candlestick perspective. In a bullish scenario, a candlestick-based breaker block appears when an area fails to reject the price. This is represented by the last selling candle that forms just before a strong upside move. That candle usually breaks below or sweeps the liquidity of the lowest point of the previous candle. In a bullish diagram, we would highlight this red candle as the breaker block because it is the final bearish candle before price launches into a sharp upward movement after sweeping the previous low. A similar idea applies in the second candle sequence. Here, the breaker block is the last small bullish candle that forms right before another sharp upside move, breaking below or sweeping the liquidity of the previous candle's low. These same principles hold true in bearish markets as well. It is also important to remember that these concepts work across different time frames and on any price action-based chart. To identify valid breaker blocks and use them effectively, we need to consider several criteria and rules. The first point is the clearing of buy-side or sell-side liquidity. For a breaker block to be valid, the price must take out a clear area of liquidity before forming a market structure shift. Here is an important pro tip. When identifying a valid order block, the price must break and close above or below the recent swing high or low to confirm a proper break of structure. However, this condition does not apply to breaker blocks. When identifying a breaker block, the candle body does not need to close above or below the recent swing point. The second rule states that in a bullish scenario, the sharp movement should create a higher high, and in a bearish scenario, it should create a lower low. This helps filter out isolated candle spikes and avoids relying on manipulated or emotionally driven moves before a market structure shift forms. The third rule highlights that once buy-side or sell-side liquidity has been taken out, the price must begin to reverse its direction. The fourth rule states that a breaker block is only considered valid if the price breaks and closes below or above the breaker block with the body of the candle. A simple penetration with a shadow or wick is not sufficient. Rule number 5 explains that breaker blocks are treated as one-time use zones. This means we focus on the trading opportunity when price first returns to the breaker block. Once the area has been mitigated, it is no longer considered an active zone for future setups. In other words, a breaker block is not just a random reaction level. It represents a structural roll flip after liquidity has been cleared and market direction has shifted. When you understand how failed order blocks transform into new supply or demand zones, you begin to read price with logic instead of emotion. With that foundation, you can combine breaker blocks with liquidity and structure to build high-probability trading opportunities. So trader, please remember that the ComLucro channel is focused on giving traders clarity, confidence, and structure. And this Smart Money Concept series is designed to do exactly that. Each video breaks down one ICT concept in a clear and practical way, helping you understand how price behaves, where liquidity forms, and how market structure develops. If this explanation helped you see the market with more clarity, make sure to check the full Smart Money Concepts playlist linked on the card and in the description, where all these ideas are organized step by step into a complete learning path.